So this book, a mere 623 pages, can change your financial future forever. And if you don't believe me, here's what Warren Buffett has to say.
Changed my investment philosophy. It really changed my whole life.
I want to cover the 3 big takeaways that this iconic book, The Intelligent Investor, has to offer us, and more so, how we can use it to increase our own wealth. In the world of high-frequency trading and complex financial instruments and the whole noise from the cryptocurrency space, it's very easy to forget the timeless principles that this slab of a tree has to offer us. This book was first published in 1949, just after World War II, and was written by Benjamin Graham, who'd also lived through the Great Depression and ended up a massive success. Ben Graham's decades of experience in some of the harshest conditions in living memory provide an easy-to-follow roadmap to navigate the ever-changing financial world. And given the age of this book, over 70 years old, the remarkable thing is the lessons it offers are more valuable today than they ever once were. So the first big takeaway from this book is dead simple. Focus on the fundamentals. And I know it's kind of obvious, but bear with me. We live in a world of information overload, and it's easy to get caught up in the noise of the market, predictions from Jim Cramer, and daily fluctuations in price predictions from experts like Cathie Wood. However, Graham's core principles on focusing on fundamentals remains to be the cornerstone of successful investing. He thinks that by examining a company's financial health, their earnings growth, and their growth prospects, investors can make a more informed decision on whether a stock is actually undervalued or overpriced. And it might sound like a lot of work and hard to do, but Graham's method of fundamental analysis is actually really simple. It involves examining just 3 areas of a company and a business: their balance sheet, their income statements, and their cash flow statements. Examining these metrics helps investors determine if a company has a strong financial position, if their earnings are going to be constant, and they have the ability to generate future cash to support the company's operations and future growth projections. By focusing on these 3 big fundamentals, investors can avoid being swept into market hype or even market panic like we're seeing today, and make more rational decisions based on objective data. The basic theology is that if a person looks at the financials, they can be objective and avoid overpriced companies when things look too good to be true, and avoid a potential massive loss when things go south. And this leads on perfectly to the second big lesson from this amazing book, and that is one of Graham's most famous concepts, something called a margin of safety. The idea is to purchase a share or a stock when they are trading below their intrinsic value, giving you in essence a safety net if an investor's analysis is wrong or markets themselves turn south. And believe it or not, side note here, people as a rule of thumb think they're actually smarter than they really are, and you could double that belief and thesis when it comes to investors. Ben Graham believed that this margin of safety was the key to all successful investing, and he states in Old English, the function of the margin of safety is, in essence, the rendering unnecessary accurate estimate of the future, which does sound confusing, but to put it simply, a margin of safety essentially eliminates the need to make an accurate prediction on a future stock and its price. He also continues in this statement that if the margin of safety is a large one, then it is enough to assume that the future earnings will not fall below those of the past in order for an investor to sufficiently protect themselves against the vicissitudes of time. And yeah, I can't pronounce vicissitudes. It's not happening. Something of note here is that when Ben Graham identifies a safety of margin, he's not necessarily talking about a price looks cheap on a stock chart. Often in the book, he cites examples of a stock that is selling less than the amount of some of their other assets on their balance sheet. An easy example that I'm making up on the spot here is, let's say a company has assets and buildings worth 10 billion US dollars. If the current company's market cap valuation, the total value of the business, is mispriced and at 9 billion, that shows the market has mispriced this asset, and you could be buying it at cheaper than the actual worth of the company's assets. Another example could be that there's a stock that's selling for less than the amount of the bonds that could be actually issued against the property or its earnings power. This means that it could have a margin of safety too, and if an investor buys that stock, they could get a safety from a bond that also has the opportunity of higher income and growth from the actual common stock and company company performance itself. I hope that does make sense. If it does confuse you, Ben makes a much better explanation than I do. And now this brings us on perfectly to the final takeaway from Ben's book. And in my opinion,
we don't care.
The absolutely most important aspect of the book and overall investing itself. And that is the importance of having a very disciplined approach to investing. Something which has been echoed through icons like Warren Buffett over recent decades. This message has still seemingly been lost on many retail investors. Graham has advocated for a systemic, unemotional investing process. He believed that maintaining a disciplined approach, investors could avoid the pitfalls of market timing and emotional investment decision making, which often lead to poor and underperforming investing outcomes. Graham's disciplined approach is actually quite simple. It's setting clear investment criteria, for example, setting a minimum level of earnings, a minimum level of dividend, financial strength, and also just in essence sticking to these rules that you're going to set. This approach will help investors avoid the massive temptation of chasing hot and popular stocks that you see here on YouTube. It will also help you stop from panic selling a good undervalued asset that you own when markets head south, and it will ultimately lead to you being more consistent with longer term results. In addition to maintaining just a disciplined investment process, it's also important to be disciplined when you review your own current assets. Graham emphasizes in the book the importance of regularly reviewing and rebalancing your portfolio, and that's quite hard to say fast. Regularly reviewing and rebalancing. Try and say that fast 3 times. But myself, this is something I am trying to work on. Rebalancing my portfolio periodically and addressing its performance and revaluing the stocks within the portfolio itself. By looking at this, investors can make the necessary adjustments, selling overvalued stocks and reallocating the funds into new attractive opportunities. But a key one for me that I took from this aspect is the fact of selling stocks you were clearly wrong on. Because as investors, we have to accept that we're going to be wrong when we pick stocks or any investment. Graham's timeless wisdom serves as a reminder that despite the ever-changing financial landscape we're currently in and the allure of new day trading and new investment strategies, the fundamental principles of investing and value investing remain constant. It is important, however, to remember that no investment strategy is indeed foolproof, and that even with the most disciplined approach, with the biggest margin of safety, investors can still experience periods of underperformance. However, by taking away the lessons from this book and applying them consistently, investors can definitely improve their chances of achieving a long-term financial future through investing.
I'm rich.
Warren Buffett put it best, and by the way, Warren Buffett was an actual direct student of Benjamin Graham himself. He said that to invest successfully over a lifetime does not require a high IQ. It doesn't require unusual business insights or even insider information. What is needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that very framework. Investors should really take note of what Warren and Ben are saying here, and if you want to see more of Warren's own investing system, check this video out up here. A big thank you to all the subscribers of the channel, and be safe out there and good luck.